In this video, I'm going to teach you something. I'm going to show you how to invest in an Airbnb business in the US, own US real estate as a non-resident, and what it means from a tax perspective, how to structure it, how to go through it. I'm going to share my screen. We're going to put the little blocks there. I'm going to show you what tax forms to file. I'm going to give you recommendations. There's a lot of variables, and it's really hard to give like a one-size-fit-all answer for everyone. And I do calls every day, all day. I'm doing these calls. I'm talking to people who, some people have like, oh, I have one house, it's worth $200,000 and I own it like this. And then I talk to a guy, I have 57 rental properties and they're structured like this. Depending on what country they're from, depending on what their objectives are, where they want to sell, what they want to do. My recommendation is always going to be different. So I'm going to go over some of the most common ways to own real estate, what it means and what you should be concerned about. But I'm also going to say that this is extremely specific advice. And if you own real estate outside of the US, you should just go to jamesbakercpa.com/schedule, pay for a technical call. I'm still doing all the technical calls, so you'll just speak with me and we can talk about your scenario, map out what it should be, what it shouldn't be, how we should do it, and get a plan going. So to start with, I'm talking to my non-resident friends. I'm a CPA, I've been doing this over 15 years for non-residents. And these are people who live outside the US but have US real estate. When we're talking about real estate in the US, it's obviously subject to US income taxes because it's based in the US. Now, we clearly have US real estate taxes. You can't avoid that. You should look into it when you're doing an investment to see how much it is. But income taxes also are based on state by state and depending on what kind of entity you choose. To start with, a big thing with real estate is legal liability. It's often recommended to have an LLC own the real estate that you own. It's complicated for people in Canada, for example, because an LLC pays tax and an individual, and in the US, the individual pays the tax. So let's go through example one. I'm gonna share my screen and I'm gonna go through like the most common way people do it. I'm gonna do it right now. The most common thing right here is just you have the title to your LLC, or the title to your property. Right now, in this example, Bobby from Kenya is going to own this house in Florida. So what happens in this example? Bobby files Form 1040 NR and pays income tax on profits personally. This is the most basic and suboptimal way to own real estate in your own name. Because if you die, then you have all these issues of getting the title changed. When we talk about the title of the property, in the US, how it works is when you buy a property, you sign a deed and the seller signs it and then you sign it. And then on the state, tax collector, the state deed office, it's different with every state. They record it and then it's published. And then that's formally like you're the owner. It's a pretty secure, pretty good way to own property. It works great. But it's because it's so formal, it's hard to just change. It's easier than in some countries, in some places, but in the US, it's easy to change, but like if you're dead, you can't sign it and it's tough. So estate taxes is an issue. So what we generally would recommend, and it's like, 99 out of 100 attorneys would recommend you own your real estate under of some kind of company or LLC. Bobby from Kenya, Florida LLC, and then that's going to own the Florida house. Now this has the same tax results as here. However, it has more legal protection. The LLC doesn't pay taxes. Now, Bobby does also have to file a Form 5472 for foreign-owned single-member LLC, but there's no tax on that. Now, this is great. You own one property, one LLC. It might be good to do it this way if you have a small portfolio. If you have a bigger portfolio, let's get into that now. And this works the same if you're doing Airbnb or if you're buying the houses or if you're renting the houses. If you're renting the houses, you need to operate through a business. It's honestly a little easier. If you're just doing rentals, you just open the LLC, do all the rentals in the name of that LLC, you have rental income, rental expenses. If you have an LLC, you personally pay taxes on Form 1040 NR. The LLC never pays taxes, it's disregarded. We can look at the Form 1040 NR right here, really briefly, and you would put on your income on here, calculate your tax, pay your tax, whatever. Sorry for saying whatever so much. I'm not trying to be dismissive. I'm trying to keep it moving. I'm trying to stay focused here because I could talk about this for 45 minutes and I don't want this video to be 45 minutes long. Bobby from Kenya is like, no, I want a more thorough structure because I have more properties and more stuff I want to invest in. Now we're going to do it like this. This is a more advanced structure, and something I often recommend is going to be a Wyoming LLC. It's going to be Form File 8832, corporate election. You could also open a corporation, but it's really an LLC that has elect to pay taxes as a corporation. You do this for a couple of reasons. It makes it easier to manage the taxes. You just pay the company taxes instead of Bobby paying all the taxes. And this is when you have a bigger portfolio. We're gonna have Florida LLC, and then again, Florida house underneath it. It's more complicated, but I'll explain why it might make more sense. And let's make this a little different. Let's do California LLC, and then we have a California property, Idaho LLC, and then we have an Idaho property. For all my non-resident friends on here, comment if you've never heard of the state of Idaho. And if you're still watching this video, I'm making it just for you. There's 5 people going to get value out of this. So this is a super common way to structure it, because right now, Bobby files nothing and pays no tax. Wyoming LLC files Form 1120 and reports the income, the profits of all activities netted together. The LLCs don't file anything. Great, you don't even need an EIN number for these. These just exist to own title to the properties. So this can be easier because you have one tax return. This one, even this one, with legal protection, you have 2 separate tax returns you have to file. And you have to do depreciation. You have to put your own name on everything. You have to do an I-10 application because Bobby needs to have a tax ID to file. On this, we have one corporate tax return. The concerns with this are that there's more like regulations with a corporation. You can't just send money. So in this Florida house, you just have to pay tax on your income and expenses. Where you send, what you do with your money doesn't really matter. On this one, we have to disclose how much money you send from the LLC to yourself, but there's not a tax on that. You ultimately pay, Bobby's gonna pay tax on income minus expenses minus depreciation. He's gonna pay tax on that, and what you do with the money is fine. On this one, we have to be more deliberate with the money. You can't just take a distribution from this because it's a corporation. Dividends are subject to withholding taxes. So generally, this is going to be the best structure for someone who's going to be investing in a lot of properties, reinvesting the money, and want more protection from estate taxes as well. The ultimate example, so this one, option number 3 right here, it doesn't really change anything. This is going to be Kenya Corp. And then Bobby from Kenya owns the Kenya Corp. So if you have a foreign corp that owns the U.S. Corp, that owns the properties, there's never going to be estate taxes. Right now, in these examples, let's talk about estate taxes for a second. If Bobby dies, technically, his family has to pay estate taxes to get the title of the property on the value over $60,000. So if it's a $160,000 house, there's going to be a $40,000 estate tax. Ridiculous. In this example, same tax. Same thing applies. It's just more complicated to have it. If he owns it outright and there's no debt, you can maybe have good operating agreements, good things signed to maybe sneak around the estate tax. There's no one actually making sure you pay it. If you have a mortgage on this property, you definitely need to do this the right way to avoid the estate taxes or not pay estate taxes. Or I've had clients in this example, if you own a house worth $150,000, they take out, instead of paying to have a foreign corp and for all this stuff to protect against estate taxes, they'll buy an insurance policy so that if they die, the insurance will cover any potential estate tax liability. Now, I'll tell you, having a lot of experience helping clients with their estate taxes, that it's a nightmare to deal with. We're talking about filing a form, paying a tax, waiting 3 years to get anything back from the IRS, and then getting the clearance to get the title transferred. It's so obnoxious. This is the most common thing I've set up. Most people don't have a foreign holding corp. But this, if Bobby dies, the corp still exists, the corp still pays taxes, no one really knows. Obviously, Bobby needs to have a will, we need to have corporate bylaws, we need to have what's in place if something happens. But we're assuming Bobby's not super old and dying soon. So this is generally what we do for most clients, honestly. And this wouldn't really have estate tax implications. Technically it would, but not really practically imposed. This would be the most sure way because the Kenya Corp will never die. So the owner will never change. Only the owner of the Kenya Corp, if Bobby dies, would die. So this is the most surefire way on the right to avoid. You're completely safe from estate taxes. This does not have to be Kenya Corp. This could be an IB. It could be a company in Panama. It could be a company in the Virgin Islands. I don't care. It doesn't matter. It just has to not be a U.S. corp, and no money necessarily has to come from here. Now, in these examples, I mentioned you can send the money straight back. In these examples, you cannot just take money from the Wyoming company and send it back to Kenya with Bobby. You can't just take money out. You can't commingle funds. You can't play around. Any money that comes from this is considered a dividend subject to 30% withholding. Now, how do we avoid that? How do we send the money back? If you sell this house and you make $100,000, you're going to pay a 21% income tax plus state taxes. You can reinvest it. You can offset that with losses from this. You can do a 1031 exchange. There's a lot you can do to mitigate your taxes within here. But let's say Bobby's like, I need to spend some money. There's two ways to get money out. Number one, pay your self-management fees. I like to do it through another LLC, just to make this example easier, Delaware LLC. And the idea is that this LLC is going to pay, the Wyoming LLC is going to pay for management fees for services out, so there's no withholding. There's obviously limitations here. If you send money back to yourself and the IRS audits you, it's going to look like a dividend. It's going to be hard to show it wasn't a dividend. That's why I like to pay another company. This company wouldn't pay any income taxes. This would get to claim that payment as an expense. And this is a way that a lot of people mitigate the tax expense in these types of structures. It's a way that can work, especially if you document the services you're providing for this business. The ultimate way to fully liquidate, you have $50 million in all these properties. The way that you move the money out is by liquidating everything. So at closing the LLCs, selling the properties, paying any ultimate tax on this company, closing the company, and then taking a liquidating distribution back to the owner. It could be the Kenya Corp, it could be Bobby, whoever the owner is. A liquidating distribution is not subject to dividend tax withholdings. That is the kind of loophole there, and that's how we avoid it. So the withholdings if you're taking everything back. So I'm already too long in this video. Guys, I hope this is helpful. I hope I've given you some insights here, or at least shown that I know what I'm talking about when it comes to structuring foreign-owned U.S. investments. I would encourage you to schedule a call with me, and I'd love to work with you and help you simplify your real estate investing structure. A big impact here is how your home country treats the LLC, which is why a Canadian can't do this. Or a guy in a country where they treat the LLCs as corporations, you can't operate the same way. You have to be more deliberate with your cash flow. But that's something that we would review with your home country accountant. You have to review how you're taxed locally, how you're taxed in the US, and most importantly, make sure that you properly own everything legal-wise from a title perspective. So there's a lot to consider here. I'd love to speak with you. Hopefully this was helpful. Send it to a friend who's a real estate investor, and I'll see you on the next video.